Greetings everybody and welcome to class, and in this video we're going to talk about deductions from AGI or below the line deductions. Let's hit it. Okay everybody, so in this video we're going to talk about the various itemized deductions that are available to individuals. Now, before we go forward, I'm going to talk a little bit about this. I know we hit this really more deep in video 3, but you got to kind of understand. We're going to talk about itemized deductions. Now, something you got to understand is that when you have income, then you get to your deductions. That's going to get you to adjusted gross income. Then you're going to have this below the line deductions. Now, below the line deductions can actually be two different types of deductions. You have itemized deductions and standard deduction. We'll talk about standard deduction in the third video. Itemized deductions are basically going to be if you are going above the standard deduction amount, and you got to fill it all out and then kind of figure out what's going on here. So normally what happens is when you're filling out a tax return, you're just going to put all the deductions that you can on the tax return. You're going to let the system tell you which ones you're going to take. Unless you really know right off the top of your head, hey, yeah, this is definitely the deduction path we're going to go. All right. So, that's kind of how that happens. But don't think about that yet. We'll talk about this in chapter 3. But right now, we are going to be talking about deductions that show up on Schedule A. So if you want to grab a copy of Schedule A and follow us down, we're going to go down this list about deductions and how they kind of work out. All right. First thing we're going to talk about are medical deductions. Medical deductions basically are it's basically for anything that is to treat, prevent, or cure a disease. Okay, or an illness or an ailment or something. If you think about it, basically if you're going to a doctor or an urgent care, it's probably a medical expense. Okay, now there are certain things that you can't do, and most of those are going to be for like what's called elective procedures. Very common elective procedure is going to be plastic surgery. So if you want to go get that new nose, or you want to go ahead and get that turkey neck all taken care of, you can't write that off on your taxes. There is actually let me rephrase it. There is a way to do that, but in order to do that, you have to be in the business where your looks are what you're selling. If you think about it, it's models. So models who are 1099 can actually go get plastic surgery, and they can do it. And movie stars who are 1099 can also do the same thing. Okay, because they're really selling. They're selling their appearance, they're selling their acting skills, and oftentimes they have to have that. So that's like the only time you can do that elective procedure. But generally speaking, you can't do it. Okay? And no, you can't say, well, I'm a real estate agent, I need to look good in order to sell property. Well, no, you don't. Okay, that's their thought. Now, of course, you don't see too many ugly real estate agents. That's because usually they're all good looking. I don't know why, but or maybe it's just this area. I don't know. So get to this, hospitals, long-term care facilities, you can deduct the cost of the medical care that's provided, the doctor's fees, prescription medicines, things of that nature. You can also deduct, and we'll talk about this on the next slide, but you can also deduct your travel, okay? It is limited to the amount of unreimbursed qualifying medical expenses. So if you go out and you spend $100 at the doctor, but the insurance gives you $80 back, you can't take the $100 as a deduction. You got to take the delta, that's $20. Okay. Now, most people are not going to take this deduction until they're a senior citizen. Why? There's this thing called a 7.5% AGI floor. Now, what does that mean? Remember I told you in the first video, adjusted gross income is a very important number because it actually derives how much we can take as deductions when we get to the Schedule A deductions. This is an example of that. So if I make $100,000 for my AGI, we'll say I have $100,000 in wages, no deductions, so my AGI is $100,000. Take that, multiply by 7.5%, which is equal to $7,500. That means only the expenses over, so actually let me back up. So it's all of your medical expenses up to $7,500 are non-deductible. It is only the amount of expenses above that, the cumulative amount of the expenses above that are deductible. So for example, if I have doctor's costs and I have all sorts of different times I went to the doctor and it all adds up to $9,000 that I had to pay out of pocket, the first $7,500 is non-deductible. The $1,500 above that is fully deductible on Schedule A. Okay. Now you might say, well, why does nobody ever get to take this? Well, usually if you have high levels of medical expenses you're paying out of pocket, you're usually making more money. Now, an exception to this generally are senior citizens. And why? Senior citizens usually, especially when they retire and they've got their IRA accounts, particularly if they got Roth accounts, they will have a lot of their income coming to them tax-free. And so they may be living off of $100,000 a year, of which maybe $50,000 is taxed. And so, and by the way, senior citizens oftentimes have high medical expenses that Medicare only pays, Medicare Part B and Part D only pay for a certain amount of it. Okay. So they can go out and get a Part C plan, which is the supplementals that'll cover some of that expenses. But for the most part, they're going to pay a lot of stuff out of pocket. Now, most Americans will have Part B, which is well, let me back up a little bit. So Medicare insurance, there's Part A, which everybody gets, and they're free once you're retired. There's Part B, which you pay into based on how much money you receive in Social Security. And then there's Part C, which is a medical insurance plan that you can buy through authorized Medicare plans. That's what's called supplemental, and that's what's going to take care of the gap that Part A and Part B will not take care of. And then there's Part D, which is your drug coverage. Okay. Part D, people have to pay for and elect into. Part B, people have to pay for. And then Part C, if they want it, they have to pay for it. A lot of people can't afford to pay for Part C, so they just have B, or A, B, and D. Okay, so if they have a medical expense and B's not covering the whole thing, they got to pay the rest out of pocket. And that's why you're going to see a lot of, especially elderly people, are going to be able to use this deduction a lot. Okay, so sorry that took a little longer than I would have liked it to, but that's kind of the way it is. All right. Well, actually, they didn't talk about the medical expense of the driving, but if you do drive around to the medical facilities, you can actually take a deduction. I believe it's 22 cents a mile. Okay. So, please note that, if somebody comes to you and says, well, I have medical miles of 1,000. And by the way, that's from your house to the doctor, from your house to whatever clinic you go to, from your house to the urgent care, all of that is deductible. You just got to be able to show I went there on this day and add up all your miles. Now, if I'm going like a mile down the road, it's probably not going to be worth it for me to do this, especially if I'm never getting over that 7.5% anyways. But I had a friend of mine who had a mother. In fact, she just passed away last year. She had a lot of health issues and she couldn't drive. So her son, who was retired, living here in D.C., would fly to Oklahoma for 2 weeks a year, out of the month. And then for those 2 weeks, he's in the car driving his mother around to all of her Medicare appointments in order to go see all of her doctors. Okay. Had huge tax write-offs as a result of this. All good stuff. All right. Taxes. There's two different types of taxes that we're going to talk about here. You have what we call SALT, which is S-A-L-T, state and local taxes, not the sodium stuff that you throw on your food to make it taste good. And then there's also foreign taxes. Now, 9 times out of 10 in the real world, we do not deduct foreign taxes. We will take foreign tax credits instead of foreign taxes as a deduction. It almost never makes sense to do the foreign tax deduction. Okay. And reason for that, I don't want to say never, but more likely than not. Okay. It's going to do better to take the tax credit. So that's why you will rarely see this as on there. Now, SALT, how do we all pay SALT? Well, we have state and local income taxes, we have state and local property taxes, and we have state and local personal property taxes. Here in the state of Virginia, you have the personal property tax, aka the car tax. Okay, all those taxes can go into the SALT tax. Now, if you live in a state where you don't have an income tax, in lieu of the income tax, you can use the state's property sales tax. So, for example, if you live in Florida, there is no income tax, but they got a ginormous sales tax because of Disney World and all the people that go down there and hang out and party. That's how they get all their tax revenue. Okay, Washington State, same thing. There is no income tax. There's a huge sales tax. All right, Texas, same thing. No income tax, huge sales tax. Okay, so if you live in a state where there is no income tax, you can take the sales tax as a deduction on your taxes, and that works out. All right. However, there is a limitation here. You cannot deduct more than $10,000, and if you're married filing separate, it's $5,000. Now, I want you to stay here and think about this. If you're single, the limit is $10,000. If you're married filing joint, for both of you, it's $10,000. That's a total of $10,000. It's a marriage penalty. Okay? Not that I'm encouraging you not to get married. I'm just saying that this is a problem for some people. Okay? But that's how that ends up happening. Interest, you can have interest that's basically for your investment interest. Okay, so investment interest, where we see this more commonly, you're going to see investment interest typically on, you'll have people who open margin accounts. And what's a margin account? That's basically where, in investments, you have two different types of accounts: cash accounts, margin accounts. Okay, a margin account is basically where you're going to go to the broker and you're going to be like, hey, I want to go out and buy like $400,000 worth of securities, but I don't have $400,000. I only have $200,000. So I want to open a margin account where I'm going to, and usually with margin accounts, the initial deposit's 50%. And so I'm going to put 50% of the money that I expect to buy the securities with into the margin account. And, so I put $200,000 in, I can go out and buy $400,000. Well, they don't give you that money for free. They charge you interest. And so you can take a deduction for the interest that you pay only up to the amount of investment income you have. So if I go out and I buy a whole bunch of stocks and I end up losing all my money off of it, I may not be able to deduct my interest. But if I get to that point where I have lots of losses and no additional investment income, I can't take the interest deduction. I can roll it forward. Okay. Another example of interest deduction, there are people who engage in what's called land banking. So what they do is they go out in the middle of nowhere and they buy land where they know that the city's growing and growing and growing and growing, and they hold the land for, say 5 years. And as the land grows around it, or as the town starts to grow around the land becomes more valuable. They go ahead and they sell the land to a developer so that the developer can go make money building houses and selling houses. All right? All the interest that you have for buying that land is an investment interest expense. All right. Home mortgage interest. You can take a deduction on all the interest that you pay on your mortgage. Now, the numbers that they have there, if the mortgage was put into place before December 16th, it's acquisition indebtedness of up to $1 million. Now, probably the thing that confuses most people about this, if I buy a $3 million house, but I have only a mortgage of $750,000 on it, and we'll say it was done in 2015, can I still take the whole deduction, interest as a deduction? And the answer is yes. The fact the house is worth $3.5 million is regardless of this. It's the amount of the debt. And by the way, it's the average amount of the debt. Well, how do I calculate the average amount of the debt? Well, there's two ways to do this. BOI, if you've ever taken one of my classes before, you know what BOI and OI are. BOI, beginning of year, OI, end of year, add together, divide by 2. Okay? That's one way to do it. Now, if a person's making periodic payments on time, it's good enough for government work. However, say the client gets a windfall. They work at one of these companies, they get $400,000 worth of stock options. They decide to cash out and they say, I'm going to pay off my loan. or pay off my house debt. Not pay the whole thing off, but put a huge chunk on it so I can reduce my house cost over time. Okay. What happens is if unless they do it like on June 30th, it's gonna cause a problem, because you're gonna have, instead of having it come down, what's gonna happen is you're gonna have it come here, boom, and then it's gonna continue to go down. So another way that you can do this, and the IRS totally allows you to do this, you can take the total interest that the person paid, divide it by the mortgage rate, and that's the average loan balance. Both are perfectly legal. And in fact, if I have a really good client that I like, I might just do both to see which one gets them the most deduction. Okay. So, again, we want to make sure that that loan balance is as low as possible. Now, if the debt was before 2016, it's $1 million or less. If it's after 2015, December 15, 2017, it's $750,000 or less. Okay. And that's total house debt, period. So if you have two houses that you're living in and you're going back and forth, you can't have more than $1 million in debt if it's before the old rules, and then $750,000 under the new rules. All right, charitable contributions. Charitable contributions can be made. Normally, they have to be made to a charitable organization, or like a 501c3, United Way, Boy Scouts, Girl Scouts, whatever. And churches are not 501c3s, but religious organizations, churches, synagogues, temples, mosques, sacred burial grounds, whatever. Okay, you can make a contribution to them and get a tax write-off on that. Now, the way it works is you go in, you give them cash, and you write off on your taxes. Now, if it's cash, it's easy. However, if it's more than $250,000, you must have a donor acknowledgement letter. And look, I'm going to tell you something. The organization's going to send you a letter because they want to tell you thank you. Why are they going to tell you thank you? Number one, they have to by the IRS's rules. They have to give you a donor acknowledgement letter. But two, they're really nice to you. Maybe you give them more money. Let's be honest. There's ulterior motives here. All right, and that's not sneaky ones, but if I give $10,000 to an organization, they don't even say thank you. I'm like, well, I'm not giving you anything anymore. Why would I do that? All right, so you're going to ask. By rules, they have to give you a donor acknowledgement letter if it's more than $250. Non-cash, up to $500,000. Just detailed receipts of what you sent in. $500 to $5,000. You're going to have to fill out an 8283, which is going to require more information. Form 8283, if you want to go look that up and see what that looks like. Basically, they're just going to ask you the name, address of the organization, how much you paid for the property, what was fair market value, how did you determine it, all that stuff. Okay. And then if you go over $5,000, you have to do an appraisal. Now, if it's $5,000 of a single item, now if it's multiple items that just go above $5,000, you make a box selection that says, no, I did multiple contributions throughout the year that just went above $5,000, and I can get over it. All right. Now they do say special rules apply to charitable contributions of certain types of property. Capital gain property. Most common you're going to see in the industry is stocks. Now, stocks are actually the best thing to do for donations. Because here's the thing. I want you to imagine, we'll say your grandfather or mother had the foresight to go buy Apple when it was back in the early 80s. And they bought shares and they held on to it for years and years and years and years and years and years. And we'll say, against my advice, they give it to you at the age of 40. You get to be my age, and they give it to you at the age of 40. Instead of holding on to it till day to death, but they give it to you at the age of 40. From 82 till now, Apple stock has got this huge gain. Okay. This can be a way to offload that gain without paying taxes. Because if I go to the bank and say I go to the church or the religious institution that I've got, and I say, hey, look, I got $100,000 of Apple stock. I sell it now, I'm going to get killed on taxes. instead of getting killed on taxes, I'd rather give it to you, church. And for the next 3 years, you don't ask me for any more money. They'll be, oh, we'll do that. Sure, no problem. Okay. And actually, I had a client once that we did this for. Basically, client was going on deployment, and we said, look, I recommend that I said, do you have any appreciated stock? He said, yeah, I do. And I said, okay, before you go on deployment, because one of the things he was worried about, he wanted to continue giving money to his church, but he didn't know how to do that without doing like direct deposits or anything like that. And I said, well, look, maybe instead what you do is you give them like some highly appreciated stock, unloads it, makes them happy, saves you on taxes, and then you also get a tax deduction for the fair market value of what you did on this. It's a win-win-win. Okay? So if you have a client that has a ton or has some significantly appreciated property and wants to offload it and not pay taxes on it, this is a way to do that and to support the cause. Okay? Ordinary income. Say you have a client who runs a convenience store. And the pastor calls up to the convenience store owner, who happens to be a member of the church, and says, hey, I hate to impose upon you. Our youth group is leaving right now and traveling over to Missouri to go participate in the youth conference. They need some snacks and foods and all that stuff. Do you mind preparing some? And he's like, oh yeah, I'll do it. And I have no issues. I'll just take it out of inventory. So he goes into his convenience store, he grabs chips, he grabs, drinks, and he puts it in sandwiches and puts it in a nice box and gives it to him. And he writes down how much it is. Well, how much does his deduction? Well, the IRS isn't going to give him fair market value for that because fair market value can't be determined at an arm's length there. So they're going to say you can only take it off of cost basis. So if I make a donation of these boxes, and we'll say that the food cost me $100, but I was planning on selling it for $150. I can't take the $150 as a deduction. I have to take the $100 as a deduction because that's my cost. And that ordinary income property is always, in cases like this, it's almost always going to be inventory. Okay, business inventory. Charitable limitation, 60% of AGI. They also say, it's the following sequence. It's 60% of contributions if applicable. Apply 50% limitation, which is AGI 50 times 50% minus the contribution subject to 6% limit. Just know if you have a client actually there's better ways to do this. If you have a client, and actually where you run into this more is really senior citizens who want to give money, but they don't, they don't have a whole lot of a lot of their income is in Roth IRA distributions. So but they still have other income like the interest dividends and all that other stuff, but it's not significant enough to allow them to this limit they run into. Now the good news is if they do overdo, they can carry that forward to the next year. But the problem is if the person constantly wants to give money, they'll never get over this. Okay. It doesn't happen often in our industry. Giving away half your money is really hard. Okay. I mean, I think the people I see that usually give the most. There's people, in Christian religion, we have these people we call the 10 percenters. Okay. And there's a passage in the Bible that basically says, look, you should give 10% of your income to the church. I'm not going to get into whether that's right, wrong, or indifferent, and that's not the point. But I have several clients that literally do the 10 percenters. They're 10 percenters, okay? And they're only given to 10%. 50% is a lot, okay? And sometimes I talk to people who are like, oh, if I ever win the lottery, I'm going to give half of it away. Talk to me before you do that. We may have some options for you, okay? And this is, I think this chart's valuable. If you can learn this chart and have a pretty good idea of it, you're going to do very well with it, okay? Yeah, they say here the capital gain property, non-operating, so they're saying for a private non-operating foundation, it's fair market value of the stock public. Yeah, stock giving, in here, why does the IRS love stock? Well, you can't finagle the price. Okay, you can't. There's no wiggle room here. You go to the stock market page. Say this is what it's been buying and selling for. That's why they like it. It's a very mechanical process for them. All right, other deductions. So I'm going to talk a little bit about this, and look, guys, I also have to kind of prepare you for what's coming in the future. Okay, when they passed the Tax Cuts and Jobs Act, there were two types of miscellaneous itemized deductions: those subject to 2%, those not subject to 2%. Those subject to 2% were suspended. In other words, we haven't been able to take them. So in previous videos, when I talked about this stuff, I'd say, not subject to 2%, don't worry about it. Or as my Japanese students would say, Kinishinai, don't worry. Okay, don't worry. Now, you do have to worry because in 2026, these things are coming back, absent action from Congress. And so far, they've shown me they're not going to do much acting. Okay. Now, those not subject to 2%, it's actually very few, very little that is not subject to 2%. Gambling losses are not subject to 2%. Now, before you guys start writing off all your lottery tickets you bought, you have to have gambling income in order to have gambling losses that you're going against with this. And usually you're not going to have gambling income unless you get a W-2G, which I think you have to win $600 or more in a year before the lottery is going to give it to you. Okay. And so prizes that are like under $200, they're not even going to issue you a W-2G. They'll wait until, like, if you go in and you get your $5,000 scratch off that you did, that you're going to get a W-2G for that. And that's when you want to be keeping all your receipts for any gambling you do after that. Now, another place where I've seen this, I had a client who was very big about going to casinos. And look, this guy makes good money. He's single, no responsibilities other than running his business, and he's pretty responsible with his gambling. But he goes to these casinos so often, they give him points, and like he gets free hotel stays, free trips to the buffet, and they've got the system completely worked out. Okay. And they go do all their stuff that they're going to do, and he's enjoying his life. Okay, I can respect that. And I remember actually where I know for years he didn't think gambling was taxable, and his answer was, well, I lose other money on this, it should wash out. And I'm like, yeah, but see, here's the problem. The IRS knows about the $25,000 prize that you won. They don't know about the $25,000 in losses that you have. And so when they get the $25,000 W-2G, they're going to be like, hey, here's gambling money. Where's our taxes? And so what we did, just a little hint, in case you're one of these guys who likes to go to casinos, join the club of the casino that you're going to be at. Because if you play slot machines, all of your losses that you have, they'll keep a record of. And then if you hit the big jackpot, you go to the casino, the membership group, and you say, okay, here's my casino card. Please print out all my losses, and you get it done. And the reason why this happened is that he had gotten a W-2G. He had actually won a $25,000 prize. And he didn't report on his tax. He didn't give it to me. That's why I didn't report on his tax. I didn't know about it. Okay. So he comes back to me. I didn't know that was reportable. And I said, well yeah. It's income. And he's like, okay, well, what do we do? And I said, well, go to this place, you go to these casinos, you remember these clubs, you get all these points, right? Do they have a record of your losses? And he says, yeah, they do. So he goes and he gets, because I hadn't been to a casino before this. And so he goes and he prints out all these forms, and then, we go and we reported to the IRS, and all taxes were gone. Okay. He was gone. He was good. So, but you can only take gambling loss up to gambling income. Okay. Casualty theft losses. Don't worry about these too much. I will not tax this in this. I will not test this in this class. It is so bloomin' rare that we see these, and the IRS has actually made these even more rare. We don't see. They used to be really taxable on the CPA exam because they were more common in the past. There's a 10% AGI limitation, and then on top of that, another $100 because the 10% wasn't enough. Okay. And then, you can also have unrecovered costs of a life annuity. So what does that mean? So You go out, you're getting ready to go to retirement. And the biggest fear that everybody has in retirement is running out of money before they die. So they buy these things called life annuities. All right. Now, if you do a life annuity, there's kind of a gambling aspect to this. Okay. And I don't mean it like in a negative connotation, but there's a gambling aspect to this. Because let's assume that you're going to buy the life annuity, and they estimate your life expectancy will be till you're 82. Okay. Based on your factors, based on certain things, blah, 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 blah. They say you're going to live till you're at 82. So they're going to price it out at 82 that they expect you to live till. If you lived at 90, you're still getting money from this life annuity, and that's where the company loses. Okay. Now remember, you're playing the short game, they're playing the long game. They've got thousands, if not millions of people that use these annuities. So they're spreading their risk when they do these things. Okay. Some will win, some will lose. It all averages out in the end. But you're one of these people, and so you make it to 90, you won the lottery practically, and you're getting money even though you're still alive. But what if at the age of 75 you drop dead of a heart attack? Well, it's a life annuity. The insurance company, they win. So the IRS actually allows you a deduction where they say, hey, look, calculate whatever that cost is that's left over that has not been recuperated, because when you buy the annuity, you're buying it for the age of 82. So we'll say you bought it at 65. Well, actually, let's say we bought it at 62. You bought it and you bought it through age 82. So that's 20 years worth. You get to 75. That's what? 13 years of life. You've got 7 years of cost that you haven't recovered. You can take that as an itemized deduction, not subject to 2%. It's good stuff there, okay? Good ways to save your clients money. By the way, most people don't know that. That's a very unknown deduction. Another one's called claim of right. That's where if somebody pays you money, and then 1 year later they say, we overpaid you, sorry, you got to give it back to us. Well, do you go back and amend your tax return and take out the income? You had the cash. You have to do a claim of right here, and that's how that goes. 1361, I might be wrong on that code section, or 1381, I might be wrong on that code section. I should look that up. But anyways, as Forrest Gump would say, that's all I got to say about that. All right, folks, I know it's another long video. The good news is the next two are pretty short. That's for deductions. Again, this stuff can be really complicated. I would say go through it. Try to understand what we've said on the slides. If you do what's good on the slides, you'll be fine on the test. But I hope that it actually works out for you. Again, if you have any questions, come to my office hours. And if you don't have any questions, well, that's good. Or if you want to look up some other stuff, again, the concept videos are going to be very helpful for you. And I think it's going to work out for you. So good luck with it. And I want to say thank you very much for watching this video, and I look forward to seeing you guys in class.